Today, we'll be talking about dividend investing, which can be a very complex topic, but I'll give you guys the basics of dividend investing as well as the math behind it so you guys know what's going on and you guys can avoid the dividend trap, okay? So first off, what is a dividend? Dividends are payments made by publicly listed companies to reward investors for putting their money into the venture. So a dividend is when a company makes profit and decides to share that profit with their shareholders, people like you who holds their stock. They usually pay out every quarter, but there are stocks that pay out every month. You can find out how much dividends each company pays out by going to the Yahoo page and looking at right here, forward dividends and yields. This number is a yearly rate, so if you guys want to know how much you guys get per quarter, you just take that and divide it by 4. The main purpose of dividend investing is to invest your money into dividend earning stocks so that you can just live off of your dividends indefinitely. So the easiest way to calculate how much money you guys can make from dividends is to multiply the amount of money that you have invested by the dividend yield percent. Okay? This will give you how much money you guys can make per year. Let's say that you invested $1,000 into stock X. Stock X is worth $10 per share and it has a dividend yield of 2%. To figure out how much dividends you guys would get per year, you would take the $1,000 that you guys invested multiplied by the dividend yield, which in this case is 2%. So if you guys invest $1,000, you guys can expect around $20 per year in dividend income. Now, most people and most companies usually just reinvest the dividends that they got back into the company by buying more shares. So to figure out how many shares you guys would get, you just take $20 and divide by the price of the shares, which in this case is $10. That means that $20 would buy you 2 shares of stock X. Okay, so let's say that you guys want $50,000 a year in dividends. Right? How much money do you guys need to invest? Well, to solve that, it's very easy. You just use the same equation. So what you guys are trying to figure out here is the amount of money that you guys need to invest in order to make that $50,000 a year. You take $50,000 divided by 2%, which is 0.02, which you guys can make it easier by multiplying it by 100 over 100. So then you have 5 million divided by 2, which comes out to around 2.5 million. So that means that you guys need to invest $2.5 million into stock X in order for you guys to make $50,000 a year in dividend income. Is that a lot of money? Yeah, okay. In my mind, $2.5 million is a lot of money. Not everyone has $2.5 million. So let's say that you guys invest in a stock that gives you a higher dividend yield. Let's say 5%, which means that you guys would need around $1 million to make $50,000 a year. So you might be wondering, why don't you just get a stock that gives you a higher dividend yield, like 7% or even 10%, okay? There are stocks out there that gives you guys a 10% dividend yield. However, if you guys just look at the dividend yield and just buy stocks based on that, then that is where you guys fall into the dividend trap. But before we continue talking about stocks, let's pause a little bit and give a shout out to my sponsor, iTrustCapital, which mainly handles in cryptocurrency, and they are helping me paying my bills. So iTrustCapital is the world's largest crypto IRA. Did you guys know that you guys had to pay taxes on your crypto gains? However, there is one way and only one way that you guys do not have to pay taxes on your crypto gains, and that is to open a Roth IRA. But the thing is, most Roth IRAs do not allow you to buy and sell cryptos, and those that do are very, very expensive. But not iTrustCapital. Business Insider ranked iTrustCapital as the #1 crypto retirement account for low fees. So if you currently don't have a Roth IRA, then you should, okay? You definitely should, because crypto now is going to be exploding within the next decade, and you do not want to pay taxes on those gains. So if you guys are interested, use my link below and get $100 of Bitcoin rewards when you sign up with an initial deposit of $1,000. Thank you very much, and back to the video. The dividend trap is a value trap known as a dividend trap. Occurs when investors are lured in by high dividend yields only to find the underlying company was not such a great buy after all. So enough of the hypotheticals. Let's do a real example. Let's do AT&T. Ticker symbol is the letter T. This is AT&T. Obviously a very, very big company. Everyone knows it. It is worth $140 billion and it has a dividend yield of 4.6%. But if we look back at the 1 year ago, it was worth around $30. Now it is worth $20. So within 1 year, AT&T lost around 33%. And if you think it's just a 1 year thing, no, it's not, okay? If you go back to the 5 years ago, it was worth around $37. So almost 50% since 5 years ago. Now, if all of that math is just way over your head and it's too much work for you guys, I have a spreadsheet for you guys so that you guys can just put in a few numbers and see exactly what you guys want. So this spreadsheet is in the links below, but let's just do an example of AT&T. Let's say that for shares of AT&T, you bought, 1,000 shares. At a current price of $20, that means you guys would spend $20,000 right here. This is your total investment. This is the price. This is the number of stocks. And the dividend yield is 4.6%. That means that every year you would make around $900 to $1,000. And if you reinvest this money, that means this money is constantly growing. For the next 20 years, you would make around $2,000 per year after 20 years. Your total investment would be $50,000 just from dividend, right? Just from your dividends alone. If you just hold it for 20 years, go away, baby! My baby is not going away. Now, let's just say that you guys don't have $20,000 to invest into AT&T. Let's say that you guys have $2,000. So you guys buy 100 shares. You have $2,000, buy 100 shares. But you know that you guys can save $1,000 per year. Right? So you go here, you add in $1,000 per year. Right? And then you guys can see that your total investment is growing and your yearly dividend is growing pretty well. Not bad, but if you guys go by the previous trends of the last 5 years, let's say that it drops negative 5% per year. Even if you put $1,000 per year, you can get around $100 and something per year. So after 22 years, you would have a total investment of $22,000. But if you really think about it, if you really think about it, in 22 years, you would have already put in $22,000. And with the initial $2,000 in the beginning, you would have put in $24,000 and you would have $22,000. I mean, you would have lost $2,000 and you would have lost 20 years of your life investing in something that didn't grow. So, and that is a dividend trap. So make sure that you guys don't fall into those. I'm not saying that AT&T is a dividend trap. Do your own research. I didn't really research AT&T that much, but be careful of these stocks. Let's say that you put it into Apple. Apple is currently $170. It has a dividend yield of 0.5%. But you know that you can put $1,000 in per year and you put in around $2,000. Over the last 20 years, it has been increasing around 35% per year. But let's just say it's 20% per year. And you put $1,000 a year. Within 20 years, you would have around $270,000. That is what your total investment would be worth. And you would have only put in around $22,000. So as you guys can see, the most important thing is to pick a stock that is growing. Right? Don't just be fooled by their dividends. If they have dividends, great. But the most important thing is that it is growing. All right, guys. Well, thank you so much for watching. That is all that I have for you guys today. And thank you so much. And See you guys later. Bye.